Hello and welcome to this video where I'll be giving you some revision on one area of the Advanced Tax UK syllabus that students can find confusing, which is to do with EIS and SEIS. These investment schemes have some similarities but some crucial differences, and furthermore they can impact on income tax and capital gains tax computations, which can make studying the rules more complicated. My name's Aileen Edgar and I'm an expert ACCA Advanced Tax tutor, and I'm going to use some summaries and examples to help give you more clarity over these investment schemes and when they apply in exam questions. First, let's cover some basics about these schemes. Let's start by looking at the purpose behind the schemes. There are a number of tax advantage schemes where a company issuing shares to investors meets certain conditions. In your exam, you do not need to know what the conditions are for the company beyond what I'll cover in this session. The aim of these schemes is to help new companies raise capital to support them during the early years of their business by encouraging potential investors to take a risk with these new and growing unquoted companies. This is done by allowing the investor to receive tax relief as a result of the purchase of these particular shares and/or when the shares are sold at some point later on. In this session, we're looking at two of the main tax advantage schemes to encourage investors for new unquoted companies: the Enterprise Investment Scheme, EIS, and the Seed Enterprise Investment Scheme, SEIS. The main confusion around these two schemes comes in the application of the tax relief that attaches to these investments. There are actually two different categories of tax relief for investments in EIS or SEIS shares. We've got income tax relief on the amounts invested into the schemes. And then we have potential capital gains tax relief on the gains made on the shares themselves when the investor eventually sells them, and also another potential CGT relief that defers or exempts the gain on other assets if the proceeds from disposal of that asset are reinvested into EIS or SEIS shares. We'll look at these in turn, but first of all, we're going to consider some general conditions that investors have to meet in order for their investment to get the special tax reliefs. The first thing to be really clear on is why an investment into a company will qualify as an EIS or SEIS investment. Now, sometimes the question will alert you to this very explicitly, and sometimes it will be down to you to spot whether it might qualify. One thing you don't need to know for your exam is what the conditions are for the company to be an EIS or SEIS company. Therefore, it's likely you would be told in an exam question that the company did qualify or that the shares themselves qualify as EIS or SEIS shares. But you do need to know what the conditions are for an investor in order for their investment to qualify for the special tax reliefs that we'll look at shortly. So an investor into an EIS company must be subscribing in cash for new ordinary shares. Now, cash here doesn't mean it has to be physical cash. It can be electronically transferred, but it means you cannot buy them with some other form of consideration like other shares or an asset like gold or a house. The investor must not be an employee or a director of that company at the time of the investment. At the time of the subscription for the shares, they must be independent of the company. So that means not already having other types of shares in that same company. And finally, we must make sure that they don't have an interest of more than 30% in the ordinary share capital of the EIS company. The conditions for investing into an SEIS company are similar, but the investor can actually be a director at the time of the investment as long as they're not an employee. Let's first focus on the income tax relief that could apply on an investment into EIS or SEIS shares. Remember that the income tax relief is available when the EIS or SEIS shares are purchased by the investor and allows them to reduce their income tax liability for the year by a certain amount. For EIS, that amount is 30% of the amount they spent on the EIS shares. There's a maximum investment of £1 million in the tax year that can get the income tax relief, so that means a maximum tax relief of £300,000 in a tax year. For SEIS, that amount is 50% of the amount they spent on SEIS shares. There's a maximum investment of £200,000 in the tax year, so that means a maximum tax relief of £100,000 in a tax year. A couple of things to watch out for with these investments from an income tax point of view are that EIS and SEIS investments can be carried back to the prior tax year, but there is still a maximum of £1 million or 200,000 respectively per tax year that can get income tax relief on it. And any dividends received from the EIS and SEIS shares are just taxed as normal dividend income. If EIS or SEIS shares are sold within 3 years, the investor must pay HMRC back some or all of the income tax relief given on their purchase. If the shares are sold at arm's length, then income tax payable back to HMRC is going to be the lower of the original amount of income tax relief that was deducted from their tax liability and 30% multiplied by the share proceeds for EIS shares, or 50% multiplied by the share proceeds if we're looking at SEIS shares. Now, if the sale is not at arm's length, then the whole amount of original tax relief given needs to be paid back to HMRC. So the only difference in treatment between EIS and SEIS shares here is that it is 30% or 50% of the proceeds that we might use with an arm's length sale. Let's have a look at an example. We've got Maya here, who in the tax year subscribed for new ordinary shares in an EIS qualifying company. She paid £50,000 for those shares. She had income tax liability of £23,500. She plans to sell the shares after 2 years for proceeds of £60,000 at arm's length. We have to calculate her income tax liability for the year and work out how much income tax relief will be withdrawn in 2 years' time, if any. She is within the £1 million maximum investment in the tax year that can get relief, so we take the 30% of the amount she spent and deduct that from her tax bill to get £8,500. Now, if she sells in 2 years' time at arm's length, then she doesn't meet the 3-year holding rule, and some or all of the tax relief previously given is going to be withdrawn. The amount withdrawn is the lower of the original income tax relief of £15,000 and 30% of the proceeds when they're sold. So that'll be 30% of £60,000, which is £18,000. £15,000 is going to be our lower figure then, so the amount that's clawed back by HMRC. And so that is the full amount of tax relief that was originally given. Now, if the transaction had not been at arm's length, then it would have just been the full amount of £15,000 originally given that would be clawed back. We wouldn't have had to do that comparison to the 30% of proceeds. Now let's look at the capital gains tax relief that could apply to investments that we make into EIS and SEIS shares. The CGT reliefs have more complex rules and more differences between the treatment of EIS and SEIS investments. One of the key things to remember here is that we're looking at a totally different tax that is being relieved now, capital gains tax rather than income tax. And there are 2 impacts on CGT that an investment in EIS or SEIS shares can have. Firstly, as long as the EIS or SEIS shares are held for 3 years, then any gains made on their sale will be exempt from CGT. There's another more complicated application of a CGT relief, though, to be aware of. It's often referred to as EIS or SEIS reinvestment relief, and is a deferral or an exemption of a gain on any asset that's been disposed of around the time that EIS or SEIS shares have been bought. EIS reinvestment relief is a deferral of a gain that arose from the sale of any chargeable asset, so it could be a boat, jewellery, building, so on. If within 12 months before and 36 months after that asset was disposed of, the individual invests in EIS shares, then the gain on this other asset can be deferred until the EIS shares are sold or the investor becomes non-UK resident. The deferral of the gain has no impact on the base cost of the EIS shares. It's merely frozen in time and comes into charge in the year in which the gain is triggered. Now, SEIS reinvestment relief operates in a very different manner. Firstly, it's an exemption, not a deferral, and only some of the gain on the disposal of an asset can be exempt using SEIS reinvestment relief. That's because the rules state that the maximum amount that can be exempt is 50% of the lower of the gain or the amount that's been reinvested into SEIS shares on which income tax relief has been claimed. This means that the maximum amount that could qualify for SEIS reinvestment relief will be $100,000, as that is 50% of the $200,000 maximum amount that can qualify for income tax relief. And the time period is quite different too. With SEIS reinvestment relief, the disposal of the asset we're looking to exempt some of the gain on must occur in the same tax year that the income tax relief on the SEIS investment is given. A few things to watch out for. EIS reinvestment relief, you can choose the amount of gain to defer as long as it's not more than the amount reinvested. So that means you could defer just enough so that the remaining chargeable amount now is equal to your annual exempt amount and any capital losses if you've got those available as well. Where we've got EIS income tax relief, there is a maximum qualifying investment of £1 million in a tax year, but we don't have that kind of limit for EIS reinvestment relief. And SEIS reinvestment relief, if we've got an individual that chooses to carry back their investment to the previous year to get income tax relief in that year, then the SEIS reinvestment relief is only available on disposals of assets made in that prior tax year. Let's continue with an example of how we apply the CGT relief. So we've got Brian, a UK resident, disposed of a vase, made a capital gain of $14,000. Same tax year, he subscribed for 200,000 of new shares, and we're being asked to calculate the maximum amount of CGT reinvestment relief if the shares that he bought were qualifying EIS shares or SEIS shares. So if we're looking at qualifying EIS shares, then he could get CGT reinvestment relief because he has reinvested into the shares within the 36 months after the disposal of a chargeable asset. He could therefore defer a maximum of the full gain of $14,000 until such time as the EIS shares are sold, or if Brian was to become a non-UK resident. This is because he has invested more than £14,000 into the EIS shares, so the full gain can be deferred if he wishes. But it is flexible, and he could choose to only defer the excess over his annual exempt amount if he wasn't making any other disposals in the year. Now in B, if instead he's investing the proceeds from the gain of the vase into SEIS shares, then he would need to do it in the same year that he's going to claim the income tax relief on the SEIS investment. And the maximum amount of exemption that could be claimed would be 50% of the lower of the amount reinvested into SEIS shares that qualify for income tax relief, and the gain, which was $14,000. Now he invested $200,000 into the shares, and that $200,000 would qualify for income tax relief. So 50% of that amount is £100,000. So we're comparing 50% of the $14,000 gain and £100,000 to decide what the maximum CGT relief is going to be, and we're going to use therefore £7,000. So $7,000 of the $14,000 gain will be exempt from CGT, and the rest falls due this year. If EIS shares are disposed of within 3 years, there's actually no clawback of CGT tax relief, because all that's happened with those is that the purchase of the EIS shares has allowed a gain on another asset to be frozen in time until the shares are sold. So whether they're sold within 3 years or not, the deferred gain will be triggered at the point at which the shares are sold. However, if SEIS shares are sold within 3 years, the investor must pay HMRC back some or all of the CGT relief previously claimed as reinvestment relief. So to be clear, this is the gain on an asset, say a building or a painting, that's been exempt from CGT because the individual reinvested money from the disposal of that asset into SEIS shares. So if they now sell the SEIS shares within 3 years of their purchase, then HMRC will look to recoup some of the previous tax relief given. If the sale has been at arm's length, then the amount of the gain that was previously exempt that is now going to become chargeable is found by dividing the amount of SEIS income tax relief that is also being clawed back by HMRC due to the sale within the 3 years by the original amount of income tax relief given. If the sale is not at arm's length, then the whole amount of original tax relief given needs to be paid back to HMRC. This is quite tricky, so make sure you spend some time really thinking through the stages here. So with SEIS shares sold within 3 years, there will be some repayment of the income tax relief given on their purchase and the CGT relief claimed against some other assets disposal which was exempt due to the SEIS share purchase. Don't forget that also when you have disposed of SEIS shares and indeed EIS shares within 3 years, that there will be a chargeable gain on the shares themselves for not keeping them for the minimum 3 years. Now here is an example to show how to work through everything that's happening with SEIS reinvestment relief. We've got Jax, who is a higher rate taxpayer, disposed of SEIS shares for £85,000 and that ended up giving them a gain of £50,000. Jax had held the shares for 2 years. Previously claiming SEIS reinvestment relief on the disposal of a VAS in order to defer the maximum amount possible of £12,000 gain on that VAS. We've to explain the consequences if the sale of the SEIS shares is to Jax's brother or to an unrelated third party. So we've got an individual who has claimed SEIS IT relief on the original cost of £35,000. We know this because the gain is £50,000, the proceeds were £85,000, so the original cost must be the difference. Now they'd have been able to get income tax reduction of 50% of that cost, so £17,500. But because Jack sold the SEIS shares within 3 years, HMRC is going to claw back some or all of this income tax relief and also some or all of the CGT reinvestment relief. If the sale is to a brother, then this is not going to be at arm's length, and so the full amount of income tax relief given, that £17,500, is going to be repayable to HMRC. If the sale was to an unconnected party, it will be treated as at arm's length. So we would compare the original amount of income tax relief of £17,500 and 50% of the sales proceeds for the shares, so that'd be 50% of £85,000, which is £42,500. So the lower of £17,500 and £42,500 is £17,500, and that would be repayable to HMRC. Now in terms of CGT relief, an exemption of 50% of the lower of £35,000 and £12,000, because £35,000 was the amount spent on SEIS shares that qualified for income tax relief, and £12,000 was the gain on the VAS that Jax disposed of. So the lower of those two figures is £12,000. 50% of that is £6,000, so that is the amount of the gain on the VAS that would have been eligible to be exempt. Now that the SEIS shares have been disposed of within 3 years, then if they are sold to an unconnected party, so at arm's length, then the proportion of previously exempt gain of £6,000 now becomes taxable is £17,500 divided by £17,500, so that's 100% of our £6,000. If the shares were sold to the brother, then the original amount of CGT relief is payable now to HMRC, and that is £6,000. So in both cases, the amount of income tax or CGT now due to HMRC is the same, regardless of whether the sale is at arm's length or not, but depending on the numbers in the question, that won't always be the case. So you do need to go through the processes as shown here in order to arrive at the correct conclusion. Final consequence for Jax is the sale of the SEIS shares within the 3 years triggers a chargeable gain on the shares themselves. The market value will need to be used for the sale if it's to the brother, otherwise it is the proceeds figure. There are an awful lot of rules to remember about EIS and SEIS reliefs, but some of the key points to focus on are the amount that can be invested in order to get relief and the rates or manner in which they receive the relief. So with the income tax relief side of things, remember that for EIS, the maximum investment for the tax year that qualifies for relief is £1 million, and the rate at which it can qualify is 30%. For SEIS income tax relief, in contrast, the limit is £200,000 investment for the tax year, but the relief is 50%. Both of these income tax reliefs reduce the income tax liability in the income tax computation. On the capital gains tax relief side of things, EIS reinvestment relief defers the gain on other assets because the individual has invested the proceeds into EIS shares, and SEIS investment relief is an exemption on a gain on some other assets because the individual has invested the proceeds into SEIS shares. And then don't forget that the EIS or SEIS shares themselves can be exempt from capital gains tax as long as they're not disposed of within 3 years. So when you see an individual who has bought EIS or SEIS shares, make sure to spend some time thinking about whether it's appropriate to discuss the income tax relief that could reduce their income tax liability. See if there's any potential gain that could be deferred or exempt on the disposal of other assets, and consider whether the EIS or SEIS shares themselves will qualify for an exemption from CGT due to the length of time that they've been held for before disposal. If this session has made you think you need to look again at some of the rules around EIS and SEIS reliefs, you can access lots of help in ACCA's free study hub. You'll find notes, flashcards, quizzes, practice questions to help you brush up on these important parts of the ATX syllabus. Make sure to access it through your study and revision phases to help you prepare for your exam more effectively. If you're looking specifically for further detail on the topics we've discussed in this session, I recommend you have a look at chapters 4 and 12 of the ATX Study Hub. There are a number of sections in there that cover EIS and SEIS reliefs. There's also a quiz in each of the relevant chapters, 4 and 12, that you can do on the content of those chapters in the Study Hub. Some short multiple choice questions testing a number of income tax and CGT areas, including EIS and SEIS reliefs that we've looked at in this session. Thank you for watching. I hope this session on EIS versus SEIS has helped your understanding of this topic and what issues to consider when applying your knowledge to an exam question on this area.